Did you know that you can invest in an ETF that will triple the stock market's rate of return when the market goes up? There's only one catch. It will also triple any losses when the stock market goes down. In this video, I'm going to be reviewing TQQQ, an ETF that will automatically triple the NASDAQ 100 stock index in either gains or losses. I'm going to talk about how this ETF works, how you can invest in it, and when it does and doesn't make sense to invest in this type of ticker. This is important because if you hope to outperform the market by not just 1 or 2%, but by double or even triple, this might be an easy way to do that without too much extra effort on your part. Hey everyone, and welcome to FinTech. By the end of this video, you will know not only the pros and cons of investing in leveraged ETFs like TQQQ, you'll know exactly how to invest in one and if it is a good idea for your portfolio. So hit the like button if you want, and let's start by talking about how TQQQ actually works. TQQQ is a leveraged ETF offered by ProShares. The full name is ProShares Ultra Pro QQQ, but we'll just call it TQQQ for short. This is an ETF or exchange traded fund, which is essentially a basket of stocks all wrapped up into a single ticker symbol, making it easy to invest in hundreds of stocks simultaneously by just buying the ETF. In fact, buying and holding a broad market ETF that just tracks the broader stock market is one of the core tenets of much of modern personal finance. But TQQQ is a little special compared to most ETFs, in that it uses derivatives and debt to leverage its return, allowing it to triple when the stock market goes up and triple its losses when the stock market goes down. TQQQ tracks the NASDAQ 100, which are the 100 largest stocks in the NASDAQ composite, which skews heavily toward technology companies. Some of the largest holdings in this index include Apple, Amazon, Microsoft, and Alphabet, Google's parent company. So if Apple reports a blowout quarter and shoots up in price, it might move the NASDAQ by say 1% in a day. But TQQQ would in response move up 3% in that same day. So to give a full definition, TQQQ is a leveraged ETF that triples the daily gain or loss in the NASDAQ 100. That word, daily, is really important here because TQQQ will not triple the NASDAQ's yearly return. Its return is calculated on a daily basis. Am I saying that word too much? Daily, daily, daily. It's important because it means that TQQQ is a potentially useful tool for a short-term investment, but it will not perform well over a longer period of time. So if in a given day the NASDAQ goes up 10%, well, TQQQ will go up 30%. Let's say that on day 2 the NASDAQ is again up 10%. Well, TQQQ will increase by another 30%. So in total, after 2 days, the NASDAQ is now up 10% twice, which comes out to being up 21% total, because remember, the second 10% increase was after we were already up a little. Meanwhile, TQQQ will be up 69%, which is more than triple the NASDAQ. This is a simple example, but it shows how powerful this type of asset can be during a bull run in the market. But remember, it has a negative side as well. Imagine one day the NASDAQ goes up 10%, then the day after it goes down 10%. Well, TQQQ will go up 30%, but then it will go down 30% again off of that larger base. So the NASDAQ will have a cumulative change over those 2 days of -1%, while TQQQ will be down -9%. Now, I'll have another example later in the video that shows this in more detail over a long time period if you don't believe me, but the math does check out. So okay, you might say, it makes sense that you would want to invest in TQQQ while the market is going up every day. And obviously you wouldn't want to invest in it when the market goes down. But doesn't the market go up on average? Shouldn't TQQQ also go up and roughly triple the average market return? Well, the common advice is to not hold TQQQ for a long period of time. And ProShares themselves say ProShares returns over periods other than 1 day will likely differ in amount and possibly direction from the target return for the same period. So even though the NASDAQ might have a positive return over a certain time period, TQQQ could have a negative return. But someone just telling you don't invest in this long term, trust me bro, isn't really the same as understanding why. So I'm going to run through an experiment that shows exactly why holding TQQQ for a long time period could be risky even in a bull market. So first off, we need to determine what the average rate of return of the market is. Well, the S&P has returned on average around 8% after accounting for inflation over the past 100 years. During that time, it has had some crazy ups and some crazy downs. But if you just held consistently over that period, you would be up around 8% per year. The NASDAQ has actually done a lot better than that recently, with the number of tech companies that have done extremely well in the past 20 years. But let's just use an even number of 10% in our example to make the math simple. So if the NASDAQ returns 10% over the next 20 years with lots of ups and downs in the middle, will TQQ return better than that or worse? So in order to run this simulation, let's just keep it simple and do everything in Excel. So let's open up Excel first. So you can see here, I already have this spreadsheet kind of set up for our TQQQ experiment. And what we're going to do is we're going to put the different prices of the NASDAQ at each given day and then see what that does to the TQQQ price. At the end of this period, we're going to have the NASDAQ being up around 10%, which is going to simulate as if it had been up for the entire year. And then we'll see what TQQ looks like over that same time period. So let's just get this set up. Okay, so we've simulated 1 day right here. In 1 day, if the NASDAQ goes up 1%, in that same time period, TQQQ is going to go up 3%. So in total in our simulation at the bottom here, we have the NASDAQ being up 1% and TQQQ up 3%. So let's add a few more days onto this. So we continue the simulation and we add a couple more positive days for the NASDAQ. It goes up 4% one day, then it goes up 10% the next day. Well, this is really the use case where TQQQ shines, because while the NASDAQ is only up 16% over those days, at the same time TQQQ is up 50%. But now let's keep running this experiment with the stock market going up and down a little bit until we get to a point where the NASDAQ is up 10% in total. So now we've run a longer simulation where we have the NASDAQ going up for a little bit, then it goes down, then it goes back up, then it has a larger down period, which would kind of be simulating a crash in the market before recovering back up. So over this entire time period, the NASDAQ in total is up 10%, which, like we talked about earlier, is about what it's going to average over a long time period. At the same time though, TQQQ is actually down negative 26%. On each individual day, all it did was triple what the NASDAQ did, but because on those down days, it was coming down so much faster, it isn't able to recover in quite the same way that the NASDAQ is. So this simulation shows pretty clearly that holding TQQQ over a short time period, if you can predict that the market is going to go up, can yield you a huge amount of returns. But at the same time, if you hold it long enough that you eventually run into a part where the market drops dramatically, it's going to be pretty hard to recover from that in this holding. So what do we take from this experiment? Well, I think it shows why the common advice is only to use this asset for a short-term investment, because the longer you hold it, the more likely you are to run into a rough patch in the market. Holding it for 1 to 5 years might be risky, but you might be okay in an extended bull market like we've been seeing recently. But it probably doesn't make sense to hold a leveraged ETF for 5 or more years, because eventually the market will dip. And those tripled losses are absolutely killer. But let's say you are interested in investing in TQQQ. I'm going to show you how you can do so. You first open up your investing app of choice. I've tested this with Vanguard, Charles Schwab, Robinhood, M1 Finance, Public, and WeBull. And for that last one, if you sign up and deposit $5 today, you'll get 2 free stocks valued all the way up to $2,300, which is what I call a good return on investment. You can search for this ticker just like you would search for a stock by typing in TQQQ, and then you can buy the ETF just like a stock. The only exception is on M1 Finance, where you need to click the Funds tab and then search for TQQQ to add it to your investment pie. M1 Finance will then rebalance your pie automatically and invest in the company. So if you are confident in your ability to time the market, this may be an ETF worth looking into. As for me personally, I am not at all confident in my own ability to predict where the NASDAQ will go. So I'm going to stick to picking stocks and investing in broad market ETFs. But if you learned something, let me know in the comments. Don't forget to like and subscribe, and I'll see you next time.